Marabang, ladies and gentlemen. I'm Hiral Datia. We have with us Mr. R.K. Thakkar, former MD and CEO at UCO Bank, joining in. Welcome to the show, Mr. Thakkar, and a pleasure to speak to you as well. Mr. Thakkar, my first question coming to you is, overall, if you see, we have the RBI, which went ahead and hiked the repo rate for the first time in almost 4 years. What does that actually mean for the Indian banking system, according to you?
See, this measure taken by Reserve Bank of India regarding the hike in the repo rate is basically inflation fighting measure. And it was expected. We were expecting in the April credit policy, but I think the RBI perhaps took a stand. They might like to wait and watch for some more time. But then the subsequent developments, especially with the Fed hike also coming in, RBI thought it prudent not to postpone it till the June credit policy and also take a stand. I think the RBI governor also made it quite clear in his various statements that they would not like to have a very big jump in the June credit policy. So just to let the market absorb the impact of the rate increase with a view to fight inflation. And that's one of the main objectives of Reserve Bank of India. I think that was the main aim of this move. And I feel it was a very right move. And we would be seeing some more rate hikes in the coming fiscal year. And this is basically inflation fighting measure. And hopefully it should not compromise the growth. That's what everybody is looking at.
Right. So overall, if you see in terms of the banking sector as whole, how do you think they are absorbing this rate hike? Because that's something which will have to be taken into consideration as well. And, in terms of how they should be coping with the new reality of elevated interest rates and tight liquidity conditions.
See, there are two things you talked about. One is the rate hike, what the impact it would have. And second thing is the liquidity position. See, rate hike, obviously, this will be virtually across the board because the majority of the bank's loans are now linked to the repo rate, including the retail loans, home loans, everything. So any change in the repo rate directly impacts the lending rate to the borrowers. So whatever increases happen to the existing borrowers, obviously, the impact would be immediate. The 40 basis hike would be there. As far as the new borrowers are concerned, the banks may take a call, especially with regard to the home loan and other personal loan segment. They may not pass on the full increase. They might absorb some of it so that their credit offtake remains robust. And the fresh lending keeps on happening at a pace which it has picked up in the last 1 year. And as far as the liquidity is concerned, there is ample liquidity in the market. If you really see, although the Reserve Bank has hiked the CRR ratio from 4 to 4.5%, that would, I think, take away approximately 89,000 crores from the banking system. But there is ample liquidity. I think liquidity is not a concern. And RBI would definitely not like to tighten the sense there is a shortage of funds by the banks. That liquidity is there and it will still remain. I don't foresee any issues on the liquidity front.
Right. And overall, if you see in terms of the banks as well, clearly, do you think lending could be impacted in the near term?
I don't think to much extent it would be effective in the sense that the credit demand, which was previously not there, has started picking up, and especially the corporate sector, from which the demand was not forthcoming due to lack of fresh capex not happening. I think that would start happening now. So that impact of the interest rates, no doubt, there is a relation to some extent of the interest rates and the credit growth. But if the demand is there, I think the interest rates by itself does not impact the credit growth, because interest cost in any funding pattern, if you really see, forms a very small part of the overall project cost. So if the companies are going for a capex and with the robust demand now happening, the issues are basically on the supply side.
Mm.
The demand is there, so the corporates would be making fresh capex, and with the fresh capex, their working capital requirements also go up. So that demand, I don't foresee much impact on the lending by the banks. To
Mm.
some extent, perhaps the retail segment may be affected to a small extent, but again, there again, it's a question of demand and supply. Demand is there. I think the people, the employment now have started. Now everything is picking up. That disposable incomes are rising. So people who has to buy a house or who has to buy a car, I think the what different it will make, it will be his eligibility may come down a little bit because of the rising interest rates. But he would still take a car loan or a home loan. So I don't see much of an impact,
Right.
unless the interest rates rise too much.
Right. So overall, if you see in terms of the asset quality front as well, that has taken crucial significance now, because a lot of special dispensations that were extended by the regulator in the wake of the pandemic to the banks and financial institutions have expired. So do you think, because in December as well, the RBI had warned of increased stress in banks' books upon the expiry of the special schemes, how do you think this is going to impact banks on the asset quality front? Because clearly, if you see the capital adequacy, that has remained sound. Do you think that the banks would be able to absorb that shock?
Yeah, there is bound to be some impact with this moratorium expiring for the various benefits which are given during the COVID time. But on the other hand, if we see, the banks have made adequate provisions in their balance sheets. The PCR ratio of the banks are quite healthy, so varying between 65 to even 85%. So which means that they have already made a provision to that extent of their NPAs. And if we see the results of the banks which are coming now for this last fiscal year, the provisions are going down, overall provisions. So that comfort the banks have. So now they have that capacity to absorb the fresh provisions they may have to make because of this moratoriums expiring. So I don't think it will impact too much on the bank's balance sheet. My only concern, especially for the public sector banks, would be their capital adequacy, because most of the banks, their tier 1 capital is not on a very higher side. It's virtually meeting the statutory norms. What I remember, the average CRR tier 1 capital of the PSU banks is around 10% plus, something like that. So that is one area where perhaps they require support. Either they have to raise from the market, or the government would be pumping in some more capital. So from that angle, I think they have to take care. But as far as they are taking the impact of the additional provisions, I think they have no adequate cushion built in their balance sheets.
Right. And overall, if you see in terms of the global inflation that's surging, and a surprise rise in interest rates could spur concerns about the outlook for borrowing costs. So do you think that the Indian banks could likely jump into the bond market now?
Yeah, the Indian banks jumping into the bond market, perhaps, yes, with the rising interest cost, there could be a move by the banks in this issue. But still, I don't feel the banks have actually, Indian banks especially, have actually been very active in the bond market till date. But this could spur that they are more entering into this market, no doubt about it.
Okay. And overall, if you see in terms of the proceeds that they raise money from the debt market as well, I'm sure that will be something from a long-term debt perspective. Is that something that they would be using for their mortgage book and long-term infrastructure projects?
Yeah, I think the banks normally are facing that issue of a bit mismatch of their assets and liabilities time. Because now most of the lending of the bank, the working capital have reduced to a great extent. Most of the lending of the banks is of a long-term basis, whether it is the retail or whether it's the corporates. Corporates also looking more as a term loans rather than going in for the working capital. Working capital, they find it more easier to raise short-term money instruments. So from that angle, yes, I think it should, the bank should be able to manage that.
Right. And overall, if you see in terms of the credit growth as well, clearly the bank credit rose to 11.2% year on year as of April 22, as compared to a 5.3% in the prior period. And that marked the first double-digit growth in credit since August 2019. Do you think this is something which is sustainable going ahead as well?
Yeah, I think well, I don't see too much of an increase in this rate of growth, but I think it should be able to maintain a double digit. My personal reading is between 10 to 12%. We should expect credit growth in this current financial year, and a good of the growth should be coming from the corporate sector, which we were missing in the last few years. The credit growth, I think, will continue as it is, but in the corporate sector, we should be seeing a revival of the growth, and that should pick up the figures for the credit growth for the banks.
Right. And very lastly, Mr. Thakkar, from here on, what according to you could be the key monitorables for us for the banking system?
I think the banking systems have to now take into account the new competition they are facing from the fintechs and other entities. And I think technology-wise, I think they have to now ensure how they use the technology to make it more customer-friendly. I think perhaps what we have been missing is that technology has been used to the advantage of the banks, no doubt about it. But how we can further modify to make it more customer-centric, I think could be the key thing. And the new technologies coming, whether it is artificial intelligence, I think a lot of work would have to be done by the banks to get the benefit out of that. Another thing obviously always remains in the bank is the talent, the human factor. And I think that's one of the major things which the banks will have to take care of.
Absolutely. And I think in terms of the banking sector, it is in a better shape as what we had seen in the previous years, and that sustainability has started to improve as well. So hoping this continues, because I think in terms of emerging markets as well, the kind of headwinds other countries have faced, we have been able to weather that storm pretty well. Would you agree?
Definitely. I think the Indian banking has been really resilient in the past few years we have seen. And why past, even the last decade and a half, after the subprime crisis, the way Indian banks have been very robust, we have seen despite so many adverse things happening, whether it was COVID or later on. The Indian banking system is, I think, now especially with the NPS issue being almost taken care of, they have a good path ahead, and I am sure the Indian banking sector will stand up and meet the needs of the industry, the economy.
Absolutely, and looking out for a good growth from here on as well. Thank you, Mr. Thakkar, so much for joining us on the show. It's always a pleasure to speak to you and get insights. Stay safe and speak to you soon again.
Thank you.
Thank you.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.